Chapter 15, Macro Investing Frameworks. Section 4, Cross-Asset Relationships. Cross-asset relationships matter because markets rarely move in isolation. Stocks, bonds, currencies, commodities, and volatility are all reacting to the same big forces like growth, inflation, policy, and risk appetite. Looking across them together can reveal what investors may be pricing before any single market tells the whole story. The stock-bond relationship is a good example of why context matters. Rising yields can come with stronger stocks when growth looks healthy, but the very same yield move can also appear when inflation is a problem or when investors are rushing into safety. So instead of reading one market in isolation, ask what macro story is linking them. Currencies and commodities often connect through the real economy. When oil or metals rise, that can help the currencies of exporting countries through better trade balances and stronger foreign demand, while importers may feel the opposite pressure. The key point is that the same commodity move can support one currency and weigh on another. Gold is often viewed through the lens of real interest rates, not just nominal yields. Because gold does not pay income, it tends to look more attractive when inflation-adjusted yields are low or negative, and less attractive when real yields rise. Even so, safety demand, geopolitics, and currency moves can still matter. So the relationship is useful but not absolute. It is tempting to assume that if two assets move together, one must be driving the other. But often they are both reacting to a deeper force like changing growth expectations, inflation, policy, or risk sentiment. That is why rolling relationships and sustained divergence usually tell you more than a single day of unusual price action. A practical framework helps turn all of this into a repeatable process. Start by naming the main macro driver, then map the market pattern you would expect. Compare that with what is actually happening, and ask whether the difference suggests a regime change. That keeps cross-asset analysis grounded in testing, not guessing. Some patterns show up often enough to be useful starting points. A growth shock may push stocks lower and bonds higher. An inflation shock can hurt bonds while lifting yields and commodities, and a risk-off move often supports the dollar and safer bonds. But these are working hypotheses, not fixed rules, so the market still has to confirm the story. When familiar relationships stop behaving the way you expect, that can be the most informative signal of all. A move in yields might suddenly be about inflation instead of growth, or severe stress can send several safe havens higher at once. What matters most is whether the break is persistent, because lasting divergence often exposes hidden assumptions in a portfolio. Imagine inflation comes in hotter than expected. The simple expectation would be pressure on both stocks and bonds. But if stocks fall while bonds rally, the market may already be shifting its focus toward weaker growth and eventual easing. That kind of cross-asset read helps you catch the narrative change earlier than the headline alone. In practice, cross-asset analysis is really about asking why markets moved the way they did. Use rolling windows to watch relationships change. Check whether your hedges still behave as expected. And remember that currency effects can reshape returns in global portfolios. Treat the patterns as probabilities rather than formulas, and they become a much better tool for risk management.